Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
All right. So, yes, Todd, there was something that you wanted to add there.
Well, you were asking a question.
Yeah.
And I'm thankful that Sarah chimed in because it gave me time to organize my thoughts on that question. I think it was, what should you be thinking about 6 months before you sell? So I think there's two things that I would offer up. The first one is timing matters. So if you're 6 months from selling, I wouldn't want that 6 months to expire in March. Like, hopefully you're thinking about like, okay, this tax season is going to be it. It's the holidays. By May, I want to start this process, right? So from a timing perspective, it's probably best to be listing a accounting and tax practice for sale sometime in the post 415 range, maybe till around now. And it starts to get a little late once you get into September, October, for all the reasons we've already discussed. It takes time for legal, it takes time for financing, et cetera, et cetera. So timing is important. The second thing is maximizing the enterprise value of what you've got to sell. And that comes into maximizing your profitability, taking on new clients. I mean, when we look at doing a valuation, we're going to look at financials for the prior year. We'll look at trailing 12 months. And a lot of times we're basing that price on the trailing 12. So if you can, I don't want to say beef up, but, do your best to kind of hold your revenue in line or grow, that's only going to help you maximize your total purchase price. Thinking about maximizing your profitability, what steps can you take to maximize profitability of your business so that if we are looking at multiples of SDE or EBITDA,
and today we've got a very special lineup, one that brings together three perspectives you don't usually get in the same room. If you were at Right Now 2025, you may have caught this group in action. The session was a crowd favorite, and we have brought it here today to share with the MYCPE 1 community. I like to title it Buying and Selling Accounting Firms, Insider Tips from the Broker, Banker, and the Lawyer. So let me introduce our powerful powerhouse, right? The panel. First is Todd Steinberg, the managing director at Thrive Financial Group. Todd has helped brokers countless deals and has seen just about everything on the buy and sell side, from family-run firms to private equity roll-ups. He's the one who knows when a deal looks great or when it's about to go sideways. Welcome, Todd. It's a pleasure to have you.
Thank you, Saul. Good to be back with you, and appreciate the platform here to speak to all of your members. Hopefully we'll be able to share our unique lens collectively with you in regards to some of the M&A trends that are happening in the industry today. And always good to be with my good friends and colleagues, Sarah and Shannon. So good to see you guys as well.
Absolutely. And moving up next is Shannon Hay, the VP at United Midwest Savings Bank. Shannon is the finance engine behind many M&A deals. He understands the lending dynamics specific to the accounting profession, including the SBA structures, cash flow underwriting, and how to get financing to actually make the deal vision. So welcome, Shannon.
Thank you so much, Saul. It's a pleasure to be here. And credited with funding more accounting deals than any other SBA lender out there. Just want to share my expertise and here to help. So happy to be here.
Absolutely. And lastly, Sarah Sharp, the partner at SKNS Log Group LLP. Sarah's a legal powerhouse in this space. She's guided buyers, sellers, and investors through everything from term sheet negotiations to post-close disputes. Our insights into risk mitigation and deal structuring is going to be the key today. So welcome, Shah. Welcome to the podcast, to the web.
Thanks, Saul. I should get that written down for my website. That was a really good intro. I appreciate it.
You got it. I'll send it to you.
Powerhouse.
Yeah, powerhouse. I like that. And it's always a pleasure to get to connect with Todd and Shannon and talk shop, which is something we do all the time when nobody's recording us. So it's nice to nice to have an audience.
All right. Let's do a quick pulse check, right? We really want to know what the M&A landscape is looking for accounting firms in 2025. So I'll just start with Todd first. So Todd, are you seeing more sellers entering the market this year compared to the last? And what's really driving that?
Yeah. So as far as more sellers in the marketplace, in my world, it's about the same. I mean, I think you've got a good mixture of people that are looking to retire and those that are looking to get involved in other business interests. I can't say that this year has been any different than years past. I think the difference is really in the volume of buyers. So that's a different question. But as far as sellers are concerned, yeah, there are those that are hearing some of the valuations because that is a changing number. I'm sure we'll talk about that to a degree today amongst the three of us. There are some that are getting teased with these unbelievable price and terms that are in fact happening in the marketplace, which for those that are financially motivated certainly could be a reason to pick up the phone and speak to a broker like us in the industry, because the numbers are changing rapidly, and we're seeing some deals that's kind of unprecedented, uncharted territory in terms of where the puck is going with not just valuations, but structure as well.
Well, with that, Shannon, I just want to get a little bit of your insights as well on this from a financial standpoint, right? Are more deals being approved, or are the banks pulling back?
No, so the accounting industry is definitely an appealing, somewhat risk-averse industry, right? Hopefully accountants are good at paying their bills and they're advising other people. So if they, it's like the cobbler's kids should have shoes. We're doing more deals than ever, just because I think we're seeing more deals. Simply, we're in a baby boomer, silver tsunami kind of moment here. More retiring accountants than ever. But I would say the buyer profiles changed a little bit. In my 10 years of doing this, it used to be we would only finance CPAs and enrolled agents, right? That was kind of where we sort of stopped. And then in the last 5 years, though, we've gotten really creative and seen a lot of non-CPA, non-EA buyers in the market. Technology-driven people, operational management folks, MBA types, folks that recognize the roll-up strategy or capacity to synergize and gain efficiency in buying multiple firms. But no, the only thing difficult about the capital market structure is the Fed rate, right? Rates are higher than they've ever been, and they've stayed that way for a long time. Actually, we've been sort of stuck at this Wall Street Journal Prime 7.5% rate for the last almost 2 years. And what that's causing is you have PE pressing the value of a deal, right, along with a high interest rate. There are deals that I'm getting worked out of from a capital banking perspective because the price point is just too high to finance. On a 10-year term at 9.5%, $1 million will cost you $13,000 a month, and you need to show that $13,000 a month in income, along with, guess what, supporting yourself from the business and getting a ROI for your investment. That some of those price points that are being created by PE, or what I call, the unicorn firms, the virtual recurring revenue type firms, are gaining that higher multiple. It's just harder to drive that 10-year financing into those high price deals. So there is a little bit of noise there, but overall, no, open for business, and did 60 million last year. We want to do another 60 million this year. So open for business.
Well, good luck with that. And Sarah, you have been on so many deals, and you've seen the legal complexities of so many deals. So has the legal complexity of the deals increased with this more PE, private equity, and this monetary recap structures that we're seeing in the market?
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
Oh, thoughtful question. I like that. Yes. So one of the things that with the silver tsunami that I'm seeing just kind of anecdotally a lot more this year is you hear it. You hear more retiring CPAs than ever, but how that actually breaks down is I have clients who are selling who are in their 80s. I have ones in their 70s, ones in their 60s, and ones in their 50s who are all retiring. So, that's, I guess, how a tsunami works because you've got all of these generations trying to retire thinking, oh, I'm going to sell to the generation behind me, but there's no one behind them. And then you have this giant floodgate, which is really interesting. Don't let that make you think that that's a buyer's market, though. It isn't. So it's still very much a seller's market. You've got PE. I've got increasingly, there's a lot of fuzziness about what is private equity. There were a lot of folks 3 years ago that had, family office money, or they had money from somewhere and somebody big, whether it's somebody that you see in the news or, it's the money comes from a big monolith and they were going to buy up accounting practices. And now they are, they're really an accounting firm with 20 offices. So is that still private equity or is that just an accounting practice buying other accounting practices? It's not always super clear. But because of the two things, of more of those folks, they always get the big law firms, the 75-page purchase agreement um, with all the fun complexities and the definitions that are, have other defined terms that have other it's a Russian nesting dolls of definitions in them and things. That's way more commonplace with private equity and financial buyers like that. But also because of what Shannon said, which is, that debt service coverage ratio is really being stretched by PE entering and raising multiples, but with the interest rates, SBA really, trying to stretch to accommodate that type of purchase price. I'm seeing a lot more complex deals, even in the smaller space with just regular SBA 7A loans. It used to be, like a 90-10, there's a seller note, there's a, cash at closing, and it's pretty simple. And now even the simple, what would have previously been simple, have, retention mechanics and way more stuff going on to try to kind of bridge those gaps. So yes, increased complexity for sure.
Well, whatever is complex, it just keeps you busy, right? It just keeps you busy. I mean, you see these innovative ways, and plus with the advent of AI, everybody's trying to just be creative with what they can do better. And AI is giving some crazy ideas. I'm
It
seeing
really,
people.
yeah, it is because a lot of people are coming to me post LOI with the most confusing thing I've ever seen in my entire life that they've agreed to with the other side. And I credit it to AI as well. Yeah.
Yeah, absolutely. I mean, it's lethal. But so, I can see that, we got the volume increasing, we got financing adjusting, and we got the legal terms evolving. So I think that sets a really good stage for a deeper dive. So, let's just take this a step further. Let's walk through the process, right? Because that's also something that a lot of people on our webinar today are very alien to. So from the initial intent to closing, what is it that the firms really need to know at each stage? So, I'll continue with the same fashion. Like I started with Todd, I went to Shannon, I'll go to Sarah. So I'll probably just take that. So Todd, at what point should a seller really bring in a broker? I know it's a very easy question, but very difficult to answer, but I'll still let you answer. So at what point should a seller bring in a broker, and what are the mistakes that happen when they wait for too long?
Yeah. Well, that's a great question, Saul. I put it in two buckets. There's the succession planning, which means you talk to a broker like me now for planning for the next however many years you think you have left in the industry. And as I always tell my clients that are considering selling, the day that you sell is not the day that you walk away from the practice. So factor in a transition time, employment for a period of time, which could in turn help protect your purchase price. Sarah mentioned this tricky little thing called retention clauses. So to help protect your full purchase price, you want to be involved as much as possible in the year or a few years following to make sure that things go as smoothly as possible. So there's a lot of planning that goes in, and there are some steps that you can take now and in the foreseeable future if you're a potential seller to really maximize the value of your practice, right? So that's bucket number one. Bucket number two is, okay, I've had it, I'm ready. Let's talk about how do we actually begin this process of selling my firm. Okay. And that process, assuming you don't call me on February 15th and we're going into tax season, is generally going to be a maybe 4 to 6 month process from start to finish. So from listing the firm to identifying buyers to negotiating price and terms, going through the due diligence, acquiring the financing, going through legal. So all those facets, and some are a little shorter, some drag into another season. Maybe we pause during tax season and it takes a year or two, because sometimes we have the first person we talk to is the perfect fit and it's love at first sight and off to the races we go. And in other instances, it's, we got to go on a bunch of really tough first dates until we find the love of our life. So with that said, it can take a little bit longer from time to time. But every situation is, of course, a little unique and different. So I think just kind of plugging in and talking about your circumstances with somebody like us to get guidance and advice is probably a good idea if you are the owner of an accounting firm.
Absolutely. The earlier the better, I would rather recommend, So thank you, Todd, for sharing your insights. And Shannon, you have also been on this side of the transaction. So how early should buyers really talk to the lender, from a buyer standpoint?
Yeah. Well, I would say when you're hunting, right? So you kind of need to know if you're pre-qualified before you go out and make letters of intent. I wouldn't blindly issue letters of intent with no understanding of my capital capacity. What is capital capacity based on? I always say buyers are only 30% of the equation, right? That the selling firm is really 70% of the equation when it comes to lending. But in buyers, I'm looking for experience, operational experience, right? Prove that you know how to do this and that you can manage this business that you want money to borrow the capital to run, right? And then liquidity, so that if things go bump in the night or things, you need a little fallback. We do working capital in our transactions, but we just, like, as a bank, the more liquidity you have, the easier it is. I would say banks love to give you money when you have it. The last one is personal credit and background check, right? If you have good credit and a good background, then that makes you a viable buyer. Now let's go make an LOI. My trigger point is always letter of intent, right? So until a seller agrees to the terms of the structure of a deal, I really can't put capital behind it. So until we know what the purchase price is there a seller note? Is it tied to retention? Maybe there's an escrow component. What's the buyer putting in down payment wise? And then we can start to build a loan around that process. The SBA lending process, the goal is 45, the average is 60. I've seen people take 6 months. I've seen people do it in 23 days, right? So there are many facets to a deal. Our biggest hangups or our biggest stalls are the asset purchase agreement, leases, and life insurance. Those 3 things are the 3 things that will stall a deal. So get those in order and you should be able to close in 30 days.
If you want to do alliteration there, it would be lawyers, life insurance, and leases.
All else.
That's exactly what I was coming to. In fact, before I head on to that, this was a question that I'd asked in one of the prior webinars, but back then we didn't have Shannon Hay, like somebody like a banker there, so nobody could answer it, because do the buyers just approach a banker when they have a rough plan? Like one fine day you wake up, okay, I think I should buy a practice. Let me talk to a banker.
Well, I just, it's, I think the question, how are you going to pay for it, should always be, it should probably be the first question you're going to ask for, because these sellers, they're expecting cash at closing. I mean, it's no longer a 5-year earnout market. That is, those days have gone to the wayside.
As a broker, it's one of the first things I'm doing to qualify buyers is they have a good resume. That's awesome. They've got experience, but either they're showing me a personal financial statement with a whole lot of money in there in terms of available cash, or they've got to show me a pre-qualification letter from a banker like Shannon.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
Whoa. Very, very interesting. And Sarah, I know you lit up like a Christmas tree when you heard about the agreements. So when do you want to see the first draft of the LOI, and what's your red flag in early documents?
I mean, I really like to be involved prior to the LOI. There's a tension there because people don't want to hire a lawyer and spend money if they don't know they have a deal on the table. So I
Hmm.
made up courses. I have so much content to try to get them to the point of being able to like avoid some of the biggest areas of error in that process. But that's what kicks everything off, and it's really hard to change. People go, "Oh, it's not binding." Like you try changing the terms mid-deal on your LOI and see how binding it is because it's poorly received. So, I saw this question come in, do buyers typically bring their own lawyer and lender or rely on the seller's network? I mean, a buyer, the first thing when I'm talking to one, the first thing that I'm asking is who are you using as a banker? And, they're often saying Shannon Hay, and I'm like, good. And when they're not, I'm going, why not? And then when they say, well, I have a great relationship with my local bank, I'm saying, oh my gosh, no, don't bother with this. They're gonna sell you on something they have no idea how to deliver on. Cash flow banking's weird, and your local bank is probably so good for certain things, but it's not for this. And so similarly, when a seller's got a good, like the seller's not, we're all interrelated. I mean, Todd's dealing with the sellers. I sometimes represent sellers. I sometimes represent buyers. Shannon is with the buyers. It's an ecosystem, but I certainly
True.
wouldn't rely on the other side to pick my lawyer for me.
True that.
I I always say we're even though Todd and Sarah and I love each other, the buyer and I are in a foxhole, right? And the broker and the seller are and their attorney, and
Yeah.
your attorney is on ours and their attorney's in theirs, and let's not shoot each other.
Hmm.
Wow, wow. That's the reason why I had all three of you together, because it's this beautiful ecosystem that you have. You all have been on deals together. And as we are speaking through this, I wanted to let everybody know there's this coordination between these three roles that is clearly critical for a deal to happen. And it's just so amazing how often firms try to, I don't know, do it yourself, this thing, or I don't know, use chat GPT, like, hey, I want to do this, help me out. Or something out there. I'm seeing these products out there, they are AI enabled products that are like, we can get this entire deal done. You don't really need somebody around, you don't need a legal expert, but that's so lethal. I'm so much against it. But I mean, and I'm glad you're talking on this webinar. I hope the message goes clear. So, you've seen each other. You also seen, you've been on part of so many deals, and obviously you've seen deals that have also gone sideways, right? A lot of the deals have fallen through. So, what is that common pitfall that you're seeing, and how do you prevent it? So, I mean, like, I know this. I think it's a wait. I would want to rephrase that, because if I were to ask this, you all have questions to say. So, I would start with Todd. Um, is pricing the most common issue, or is it something else?
If the deal is set up properly, and there's good communication, there shouldn't be surprises, right? And this is, I think, where making sure that a buyer's in touch with somebody like Shannon initially so that they know they can stand behind the LOI that they're proposing. Somebody's talking to a legal advice like Sarah so that they know what should or maybe shouldn't be in that LOI. The more that is laid out in that letter of intent, I don't want to call it a purchase agreement because it's not. It's usually non-binding, but it's a general understanding of the material terms in the deal. I think we'd all agree vague is not good. And when there's not a lot of detail in those LOIs, it's just like purchase price, closing date. And I've seen those, and yeah, it leaves a lot to still be discussed and negotiated between an LOI and an agreement of sale. And that can, especially for my client, the seller, create a real problem, because now you're in a situation where you might be locked up with a buyer for 4 or 5 months only to have a misunderstanding or a disagreement on a particular issue. And now we're trying to go back on the market, and it's December and we're running out of time. And now they got to go through another tax season. And, it creates problems. So I would just say clear, transparent communication. When you've got a broker a banker, and an attorney working together, the analogy I like to use is it's like a three-legged stool. That stool's sturdy if all three of those legs are advising and doing their job properly. But if they're getting bad advice, or maybe they're being misinformed in some instances in certain spots, then that stool could topple over. So it only takes one bad misstep for that to happen. I'd say some of probably the most common thing that I see when it comes to where things can start to go sideways. A lot of times that's they're not prepared for what might be requirements for going to get a loan. It can be a challenge in certain instances. The deal's got to be strong, but if we have the practice that's pre-qualified and they've got a good credit history, we should be able to get them through there. But there's always issues we need to work through. If everyone's trying to operate in good faith and you're willing to do a little bit of give and take, I think having a little bit of flexibility, knowing that there's going to be little issues that crop up here or there, if both sides are willing to, all push towards the same direction, which is to try to get the deal done. That's the one thing everybody's got in common, whether it's attorney, banker, broker, buyer, seller. We all want to get the deal to the finish line. So just be prepared for little issues that come up along the way.
And I want to retort my foxhole statement because it's really not a war. This is not, you're not going to war. This is not a battle. This is a relationship. And one of my many taglines is you can't have relevance without relationship, right? And so if you want the seller to be relevant in your life post-closing, which you do if you want strong transition, then you want to build a relationship, right? And foster that just as you would any relationship. It's a critical element. And so with a good relationship means good communication, right? As Todd was saying. So I'll just second what he's saying. LOI is everything. Clearly communicates your first intent of communication. So if you come out shooting, you probably are going to get shot, right? But if you come out with a handshake, you probably will get another handshake. So
I like the way you say it, Shannon.
Thank you.
I really like that analogy. And the SBA loans, do buyers really underestimate how long this SBA or this lender due diligence is going to take?
Yeah, no, I think that what they might underestimate is the expectations from the institution for you to have a tight business, right? No, that's the one kind of tumultuous thing. Like the SBA gets this bad rap of like blood of the firstborn, right? Kind of thing. But it really isn't. It's really business 101. So yes, the bank is going to require you to have an operating agreement. Yes, the bank is going to require you to have contents insurance, business interruption insurance, life insurance. They are going to make sure that your documents are compliant with the SBA program because they're reporting all this information back to the government that guarantees the loan. And if there is ever a risk of default and they need to call that guarantee, the first thing that comes into question is, was it compliant? Did you check all the boxes and make sure all the proper things were in place? Business 101. And if not, they risk their guarantee. So the bank is not going to take a chance on your inability to create an operating agreement or your inability to obtain, business interruption insurance as a reason to still do the deal. We're not going to. You have to check the box, or you can't get the money.
Absolutely. And mergers and acquisitions, the entire process itself, the more it is about the coordination relationships, the more important it is also about what goes onto the paper.
Yes,
and
exactly.
What really goes onto the paper. And that's where, I'm pretty certain Sarah has got a lot of stories to share. But if I were to ask you, Sarah, what is it, what is it from a legal standpoint that is usually a common pitfall because of it, the deals have gone sideways?
Every time a deal falls apart, which I have deals fall apart for a lot of different reasons, often it's the landlord also, because people say I have a great relationship with my landlord, so we don't have to talk to them till the very end. And you're like, I used to believe them, and then I went through a period of time where I didn't believe them. And now I recognize that, yes, they do have a great relationship with their landlord. That's why the landlord doesn't want anyone else to move into the property. They have somebody that they really like there. So that kills tons of deals and doesn't get nearly the attention that it should during the deal process. People get really tired from the bank process. So when I talk to a new buyer, I say these are equally sized projects to project manage. The deal, getting the loan. You have to be equally on top of both of them. They are separate. There's not one of these that is bigger than the other. Like, set expectations. They're not one and the same. They are separate but equally important in time sensitive deals. And that kind of intimidates people. But for the most part, the things almost every single time that kills a deal, they could have known in the letter of intent. Like, every time it's, oh, you're not willing to pay the seller for, more than $12 an hour after after the closing, but you still want them to help during the first tax season. Like, they're not going to want to work for that. So we could have known that in the LOI. Why did you pay a bunch of lawyers to draft an employment agreement to set that out before you realized that you did not have a meeting of the minds? Or a lot of times the seller owns the office space. It's like a really common fact pattern that I see. I don't know if you guys see it a lot too. And the seller will own the office space and they won't talk about the lease. And then the buyer's planning to move everything remote. Well, the seller now just has an office space they need to lease. Or if they don't own it, they might have a giant lease obligation that is going to be hanging over their heads for 6 more years. And so if the buyer isn't willing to take that on, then they're stuck paying those lease payments for 6 years, which will probably mount up to be more than the purchase price. So they're not going to ever take that deal. Why wouldn't the LOI talk about that? Because you could have known at that moment that you just didn't have a meeting of the minds. You could have gone your own way and found a different buyer who would have offered you and been more interested in terms that met up. So that's why we always are hitting the drum of put everything in the letter of intent. It's hard. People have just met. A lot of times, buyers really want the seller to like them, so they're nervous to put everything in the LOI. They want to figure it out as they go, but that's the number one way that they kill a deal. It's not that they wouldn't have died; it would have just died more humanely and swiftly if they put it in the LOI. It never would have existed in the first place, and people would have just gone on their merry way. So that's my advice: is putting everything. There are 2 big mistakes people make in their LOIs is they get one online or for some other deal and they don't take everything out. So they have some weird legacy language in there that doesn't make any sense that they're stuck with. So don't do that. If you're doing your own, it's better to just start with a blank page. And then the second is they leave stuff out that's really important, like the lease or what they're going to pay the seller after closing, or even the term or interest rate on notes is not in there half the time. One yesterday said the buyers, it was a big firm, sellers will agree to a non-compete of 5 years with a certain specified geographic scope. And now all the lawyers are going to bill thousands of dollars talking about what a certain specified geographic scope is. Is it the whole state? Is it 10 miles? So, that's just every little place that you can add detail, you should add it.
Wow. I mean, there was some interesting conversation that happened in the chat while you were talking, and I see that Shannon also talked about it. I guess, I would like to talk, like to also get your insights on it, and I would let everybody also know. And there's a question that is seller burnout a real risk mid-deal, or if the timeline really drags out? Is that one of the reasons that you're seeing deals fall through?
I'll take that one. Hopefully, if there's seller burnout, it's the main reason they're selling in the first place. So you either get burnout from deal fatigue, or you're getting burnout from tax season. So pick your poison. With respects to deal fatigue, there is a certain spot. I mean, that is a real thing where there's just a lot of issues that continue to pop up. And what started as a really, really good rapport is starting to fade, because now there are issues that are coming up and people are either going to be good to work with, not good to work with. So, that can happen. And sometimes it is best to cut your losses and move on if things aren't trending in the right direction, because as we've stated, you have to have a good ongoing relationship between seller and buyer, post-transaction into the transition phase. So you don't want what's starting to feel like a tumultuous ride and you're already fatigued now. How are you going to feel working with this group or individual 2 or 3 months down the road.
Interesting. Shannon, anything you'd like to top on that?
Yeah, I think that broker responsibility matters here a lot for sellers, right? No offense, Todd, but obviously I know he does. I'm more meaning as a compliment is that Todd is very good at educating his sellers that this is not going to be, it's not an easy process, right? It's not over the day the money hits the account. And on the buyer side, I take a little bit of accountability there. I will create deal fatigue. I promise you. You will be tired of talking to us. You will be tired of my checklists. You will be sick of me asking for the very next thing. I apologize in advance for that. Again, this is a government bureaucratic guaranteed lending program, and it comes with, just like your IRS tax that you file for your clients every year, comes with the same, things have to be done a certain way. And I deliver that message boldly and kind of confidently because, simply put, we have the goal.
True that. So if I'm hearing this right, it's not just about one big thing that will break the deal. It's like those 10 small ones happening in isolation that could just creep up all, and you're like, you never know where it comes up. All right. So thank you for sharing. So let's just get tactical a little bit over here. We want to talk about the advice that you'll be giving the firm who is considering a sale or an acquisition in the next 12 months, 2 years, I don't know. So, Todd, what should a seller do, 6 months before they plan to list?
Wait, I had something to say on deal fatigue.
Sure. Sorry.
Sorry, Todd.
Yeah,
I think you have to think about the seller deal fatigue. It's your most finite resource. You have to plan every single segment of the deal to try to minimize your deal fatigue. So I talk about that constantly. The opposite of deal fatigue is deal stamina. And you don't have much of it. So that's a thorough LOI. That's taking advantage of the critical mass and the gravitational excitement of an LOI by getting in with a quick kickoff call and weekly diligence calls with your seller so that you're not going dark on them and you're keeping it moving while they still like you. And it's starting out with reasonable documents so that you don't have to go more than 2 rounds of red lines, because if you do more than 2 rounds of red lines between lawyers, everybody gets so mad at each other. So you've got to really, at every single stage, you can't start out with a super aggressive only your side agreement and expect that the other side's going to still like you at the end of it. You've got to really try to minimize deal fatigue and manage that as its own process. So sorry.
That's fine. Because I think it's a very valid point. In fact, it's a point that is not often even discussed. These are the real matters of the deal. Everybody knows that, okay, there's going to be an LOI. Those who are going to be in that space, they must have Googled or whatever, and they know that there's going to be an LOI, there's going to be a information memorandum, there's going to be a buyer, there's going to be a seller, there's going to be a banker. But I guess they're just not realizing that deal fatigue is something that, especially, it's never like nobody's in the business of selling businesses.
Well,
right?
I mean, Todd. Yeah, this guy. But
I mean, as a broker, yes. But like if I have a business, whenever I'm going to be reaching to a point where I'm going to be selling it, I will be only selling it once. Like it's that one event like of my life, As a buyer, sure, I will be buying multiple businesses. So it's business as usual for me. But as a seller, it is like that one time that whatever I created for my entire life, now it's my time where the tsunami thing, to give it on to the next generation or something. And so it's a one-time deal. So they don't quite realize the deal fatigue is a very real thing. And I'm glad that we're talking about it. So thank you for sharing your perspectives.
The goal in every part of what I do, like even from the fact that when I prepare the transaction documents, I prepare every single thing that the bank wants at once, because most lawyers will do the purchase agreement and then they do the exhibits and then they do the promissory note, and that's exhausting. It just exhausts everyone and it's inefficient. So it's like top of mind if you want your deal to go through, is just managing the deal fatigue and the deal stamina.
Yeah, not to toot our own horns either, but I think that your expert matters, right? This is why boutique guys that do it all day every day, gals that do it all day every day, it's why it's so important to make sure you're getting the good advice the first time, the right advice.
True that. True that. All right. So yes, Todd, there was something that you wanted to add there.
Well, you were asking a question.
Yeah.
And I'm thankful that Sarah chimed in because it gave me time to organize my thoughts on that question. I think it was, what should you be thinking about 6 months before you sell?
Yeah.
So I think there's two things that I would offer up. The first one is timing matters. So if you're 6 months from selling, I wouldn't want that 6 months to expire in March. Like, hopefully you're thinking about like, okay, this tax season is going to be it. It's the holidays. By May, I want to start this process, right? So from a timing perspective, it's probably best to be listing a accounting and tax practice for sale sometime in the post 415 range, maybe till around now. And it starts to get a little late once you get into September, October, for all the reasons we've already discussed. It takes time for legal, it takes time for financing, et cetera, et cetera. So timing is important. The second thing is maximizing the enterprise value of what you've got to sell. And that comes into maximizing your profitability, taking on new clients. I mean, when we look at doing evaluation, we're going to look at financials for the prior year. We'll look at trailing 12 months. And a lot of times we're basing that price on the trailing 12. So if you can, I don't want to say beef up, but, do your best to kind of hold your revenue in line or grow, that's only going to help you maximize your total purchase price. Thinking about maximizing your profitability, what steps can you take to maximize profitability of your business so that if we are looking at multiples of SDE or EBITDA as evaluation metrics, as opposed to just like a multiple of the gross sales or revenue, that will help you maximize your purchase price as well. So those would, I think, be the two biggest things.
There's a very interesting question in the chat. And, while you're talking on it, I'm not sure why he asked that, but is there a checklist firms can use to assess if they are ready to sell? Do you have one, Todd?
I don't know that I have a checklist, like a formal checklist, but I do take people's temperatures on the initial phone call, and you can usually tell when they're ready. And in some cases, it's, yeah, I want out of here, and they are ready. In other cases, it's, I'm not really ready to guide this firm into the next phase of its growth and development. For example, I have a 50-year-old seller right now who feels like they've taken the firm as far as they can take it alone, and now they want to have access to additional resources. They want to be able to delegate some of the work because they can't find good people. So they want to stay on for the next 5-10 years, and they want to have a role in that new organization, but they feel like they've led the business as far as they can go on their own. So, there's a lot of different ways to sell today. It doesn't need to be the old-fashioned, I'm retiring and I want to exit in the next 12 months. There are people that are selling because of the valuations and because they want to roll into something bigger. We talked about the PE groups and the aggregators and the investors. Those are the individuals and groups that really want to incentivize the seller to stick around for as long as they would like to do so.
True that. And I'm gonna bank on like Shannon and Sarah to just enlighten a little bit, because as a banker you'd want some documents in place. I know Shannon, you spoke about it. Sarah, you also spoke about some interesting things like the lease agreements and everything that you really got to look into when you're really planning to put it up. You got to be careful. But if I were to really ask you, maybe I'll start with Shannon first. What should a buyer have in place before they apply for financing?
A plan. I mean, you're gonna buy a business and operate it, and you got to prove to me that you have the capacity to do so. I think you should be able to articulate what that is. So there's buyers that have the intent of buying one firm and operating it and owning it and doing nothing more, and that's totally acceptable. But you still should be able to talk about what that looks like. How do you plan to make it more efficient? How do you plan to grow it? What is your competition? Are you making technology or staffing changes? Are you adding staff or firing staff? Or a plan, right? For this particular business on how you intend to operate it. Because if you can be a non-accountant, right? You can be a non-CPA or EA. You can be the other things I spoke of, have the operational experience in some other format, whether it's technology or operationally. And if you can't articulate your what, why, and how, when, and where to the bank, I lose trust, right? And so know how you're going to own it and operate it, and transition's the key too. So we typically we don't call it a business plan because we don't want to over convolute the application process. So we change the terminology and we call it a transition plan. But that transition plan should speak to things, what are you going to start doing on day one? What are your plans with the seller, and how are you guys going to work together to make sure that there's no attrition that occurs within the acquisition? So yeah, first and foremost, a plan. Be able to tell me your vision and let me believe in it with you.
Well, it's easy as it sounds. I'm pretty certain it's very difficult for a lot of buyers, but you truly put out, you got to come out with a very solid plan. You said very interesting this. What are you going to do? What do you plan to do with the employees? What do you plan to do with the clients? These are some very legit questions. I'm pretty certain Todd also asked those questions when they come across with a plan that, hey, what are you planning to? Why do you want to do this? Because oftentimes it's an emotional thing. They're just like, oh, I want to grow. I'll just acquire a firm.
Yes. Yeah. Well, also the interesting one is, with the virtuality of accounting, right? There's a lot of virtual firms out there that
True.
may or may not actually be virtual. Like I'm a virtual firm located in Denver, Colorado. Okay, great. Where's your staff? Denver, Colorado. Okay, great. Where's your clients? Denver, Colorado. You're a Denver, Colorado based firm. You're not a virtual firm. Sorry to say, all your clients might use the portal. Congratulations. Welcome to the 21st century, but doesn't make you virtual. A virtual firm should have clients in all 50 states, or at least some other geography other than where you're physically located. And it should have probably staff that has those same capacities and operates functionally that way. But if that's the question and you answer that way, and then you say, but I'm going to live in Florida and run it, I say to you, what's your plan? And it better make sense, or I'm not going to I'm not getting, just kidding. The money, where the money goes matters based on those facts, right? If the money goes or not.
True.
Right?
True. Really interesting. Sarah, over to you. Seller readiness, the documents.
I'll supplement kind of what Todd said on the seller readiness part, which is, it's like it's never too soon to talk to Todd, because you may not be ready to sell. Your EBITDA or your margin might need a couple adjustments. You want your TTM to be high. So your trailing 12 months need to be good for what you think that the business can do. And you kind of need to be growing. So if you had a bad year last year, and you'll have to explain that to buyers. So maybe that's not right. I don't know. But maybe it's fine. Maybe there's an obvious non-recurring revenue type of EBITDA adjustment that needs to be made. So you can just paint a better picture to buyer. Talk to Todd sooner. And then if there's easy low-hanging fruit that you can change in that 1 year, you can do that. And you know exactly what you need to shift to be able to be more attractive to potential buyers, and you can talk to them again the next year. I have sellers I've been talking to kind of a couple times a year for years before they actually sell. And that they're in a better position when they sell, because they know also they've done the math on what money they need to be able to retire. So they need to reverse engineer into, okay, well, this is the money I need to retire at this age, and this is what I can get from my firm. How can I increase what I get from my firm while I'm also reducing what I need to retire, because years are passing. So, you'll be able to figure that out once you talk to Todd. And also, if you're willing to stay around, and talk to Shannon. But if you're willing to stick around for a little bit, you can usually get a higher price for your firm.
I'm sorry. The reason I raised my hand, Sarah, was that there's a component to the SBA that doesn't get talked about very often. And I just saw an angle to talk about it. Is if you're a seller and you know that you're going to be selling internally, so you might not necessarily ever go into the open market, right? You're going to have a succession internally. If you grant equity to your partner, that equity can then turn around and be leveraged as a down payment to buy the rest of the firm. So if I have $1 million firm, or let's call it a $2 million firm, and I grant 10% to my partner, in year one. And then in year three, I go back to the bank and I say, he's got 10% ownership already. Great. Now he doesn't need a down payment. Now he can buy it 10% ownership. So sorry, I just want to throw that out there.
Yeah, that's fantastic. I never even thought about that angle. So, there's no harm in starting the discussion on the earlier side. There is significant financial loss in starting it too late when you don't have enough, your finances are trending down and you don't have enough gas in the tank emotionally, physically to be able to make an effective transition.
Wow, very interesting. Well, we are seeing few questions that are coming into the chat around readiness. So, that kind of ties in perfectly here. And I know we are approaching towards the end as well. So to wrap this up, I'll just want to tap into your wisdom, each one of you, just one more time. And if you could just let me know about the one trend or insight that you think every firm should be paying attention to right now. Well, I'll start with Todd.
Yeah. I would say the one insight that's important is choose your advisor carefully, whether it's a broker, banker, attorney, or colleague, friend, whoever's going to be advising you. You don't want to mess this up. So, getting good advice, it's the old, you don't know what you don't know, and what things should you be thinking about, whether you're a seller or a buyer in the transaction. A good advisor is going to do more than help put the deal together for you, whether it's financing, legal, or just matchmaking. It's going to be giving you things to think about. So you get out in front of potential problems. No deal maker can tell you they have 100% success, no lender, no attorney, right? We're going to stack the odds of being successful in your favor by getting good advice. So I think it really does start there. And I would also say have patience, because whether you're a seller or a buyer, you're anxious to do a deal. You have something in front of you that looks good, whether it's a buyer or a seller, and you're anxious to make it work. But if it's not starting to look and smell good, you need to be able to walk away and move in a different direction. So sometimes it's best to just take a step back and say, you know what? I know we were close, but let's regroup and reset. There will always be another option. And as frustrating as that can be, I think in many instances, that's the right thing to do.
Thank you. Thank you, Todd. Shannon, over to you.
Oh, gosh. Yeah, that's a lot of pressure. I first of all, echo Todd. Yeah, the trusted advisor thing is so important. I see so many people come already broken, meaning misadvised, and their perception of everything is it kind of goes back to one of the questions here, right? Is do you use the seller's team? It's like, well, does the seller who is the seller's team and what are they recommending? Like, if the seller's broker was recommending Sarah, my goodness, you'd be a fool not to take that advice. If the broker's, if you're a seller and you're calling me as a banker, I'm going to recommend Todd, right? Because, I've done deals with him. He's successful at what he does. And I hope the two would say the same about me, is that, repetition creates expertise. And that is not something that should be second guessed. Because my intent is not, look, I'm a big believer that you get what you give, right? And that's why we do podcasts. That's why we do thought leadership. That's why we share the information with no ROI. The ROI is that you hope that as we build trust, right, in what we're saying, and that gives you the confidence to want to use us. I like to win every deal, but I don't have to. I really want what's in the best interest of my customer, because I'm getting married to you for a decade, right? You're going to take a 10-year loan with me, and I want you to love me long past the honeymoon, right? So,
Shannon, I just love the way you put things across. It's so delightful.
Thank you.
So delightful. And Sarah, probably to tap a little bit on the legal or compliance risk, what is one trend or insight that you think every fund should be paying attention to right now?
Oh, there are a lot, but I do want to say that what they both just said, Todd and Shannon, is one of the reasons I love working with them, right? Because the lawyers get paid either way, but these guys are so ethical and in it for the long term that I consistently see them give really good advice that's sometimes against their own interests, which is not something that is ubiquitous. So it is really, really nice to see and to hear, because it is true that sometimes the best deal is no deal, or at least no deal right now. And the compliance risk, there's all kinds of fun stuff happening. I don't know if you guys saw like the Washington sales tax that now applies to professional services, and who knows if that'll become a trend for other states. There's so many fun things. Of course, you can look at 7216 consents now that more people are outsourcing labor. That's a big thing that I get a lot of calls about. There's plenty of fun to be had in this industry from a legal perspective.
True that, and as we are coming to the end of this, I think next time I'm going to get all three of you together. I'll probably, like, instead of introducing you as you are, I'll probably just say this webinar is with the three musketeers and Datagnan moderating this webinar. So that's how I'm going to say it. But it's been a pleasure. It's been a pleasure to have you three. With this, we come towards the end of this webinar. And to all our attendees who have tuned in, thank you so much for joining in. Thank you for putting in those questions. They were really insightful. Any questions that were not been answered, we'll surely take that up, share it with our speakers, and they can get back to you with the answers in due time. So with that, thank you, Todd. Thank you, Shannon. And thank you, Sarah, for your time. Until next time, take care and have a blessed day ahead. Cheers.
Good to see you guys.
See you. Bye.
Thanks.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now